I think that the big buyers of the week were the Chinese. I think the Chinese were able to take advantage of the fact that the market sold off on the news that they weren't buying gold in May to buy a bunch of it in June. And in fact, they're probably going to end up buying more gold in June than they would have bought in May. But because they announced that they didn't buy, they created a sell-off, which they were then able to take advantage of. Now, whether they were smart enough to figure that out in advance, to think, hey, why don't we just stop buying for a month, and then we can tell the markets that we didn't buy, and then the markets will jump to the wrong conclusion that we're done buying, and then we can really step it up.
China's abrupt pause in its vigorous gold purchasing spree, following an intense 18-month period, has caused a notable drop in gold prices this week. As the world's largest gold buyer, China's decision to halt purchases has sent significant ripples through the precious metals market, underscoring its substantial influence on global gold dynamics throughout 2023. The People's Bank of China led all other central banks in gold acquisitions, boosting its reserves to over 2,000 tons as part of a broader effort to reduce reliance on the US dollar and strengthen economic stability. Chinese consumers mirrored this trend by heavily investing in gold coins, bars, and jewelry, viewing these purchases as safeguards against volatility in Chinese stocks, currency, and real estate markets, which have faced considerable pressure. Recent data reveals that China has temporarily suspended its gold buying spree, a surprising policy shift that has caught many investors off guard, though it's not unprecedented. Renowned analyst Peter Schiff argues that historically, China has strategically paused to assess and capitalize on more favorable market conditions. This strategic pause is likely aimed at leveraging lower prices to maximize the value of their investments. Interestingly, despite the absence of Chinese buying, gold prices have recently reached new highs, indicating significant influence from other market factors and buyers. On Friday, gold prices modestly rose, recovering within a consolidation range after a sharp drop on June 7th, underscoring robust demand supported by various global economic factors. Furthermore, central banks in emerging markets are increasing their gold reserves to hedge against anticipated fiat currency devaluations, particularly the US dollar, as they shift from paper currencies to tangible assets like gold. Peter highlights this trend as a strategic shift in reserve management, emphasizing a preference for assets that maintain value during economic instability. Clips from Peter Schiff's interview will be presented shortly, but before we proceed, please consider subscribing and turning on notifications for more updates. Thank you, and enjoy the video.
This week, gold was up, and it finished the week strong, up almost $30 today. We closed at 2,334-ish on the day. It wasn't as big an up day as Friday last week was a down day, but because we moved up for most of the week, we ended up recovering all of last week's losses and then some, because between the 2 weeks, gold is actually positive. And the fact that gold was able to rise 2% this week in the face of not only a less dovish Powell, but also a strong dollar. The dollar index got hit pretty hard on the week. Let me pull it up. The dollar index closed at 104.8 last week, and it closed this week at 105.5. So about a 75 basis point move up in the dollar. Yet despite the strength in the dollar, we saw strength in gold. But even though we had that strength in gold and silver, by the way, although silver was not able to recover the $30 mark, it was still up on the week, and it closed at $29.63. Figure that out in advance to think, hey, why don't we just stop buying for a month, and then we can tell the markets that we didn't buy, and then the markets will jump to the wrong conclusion that we're done buying, and then we can really step it up. Because I think that the Chinese wanted to back off a little bit. I mean, they've been buying for so many months, and all of a sudden gold spikes up to a record high. It makes sense that they'd want to just back away a little bit and let the market breathe, let it pull back, and then resume their buying. Contrary to the way the markets reacted to this news, I think it's very good news that gold made a new high rather, without the Chinese buying. Because a lot of people thought, well, maybe it's only China, right? China is the driver of this rally. They're just one of the buyers, because even though China didn't buy it all, we still made new all-time record highs. And so I took that as a bullish indicator, not a bearish indicator. But one of the reasons I think that you saw such a strong gold market during this past week is because the Chinese resumed their buying. But it's not just the Chinese that are buying, it's all these emerging market central banks that are buying, because they understand what's going to happen with the US dollar. They understand what's going to happen with fiat currencies in general. And so they want to do what they can to diversify their reserves out of paper into real money. And so they're buying gold. And of course, the most over-owned fiat currency, the fiat currency that represents the lion's share of reserves, are US dollars. And so to the extent that foreign central banks are going to buy are going to buy gold, they're going to pay for it disproportionately with US dollars, which is why ultimately the dollar has the most to lose. And in fact, since the dollar just rose against other fiat currencies, that gives the Chinese an even greater incentive to use those dollars to buy gold.
The Federal Reserve chose to keep interest rates steady this past Wednesday, while hinting at a possible rate cut later this year. Their cautious stance is driven by persistent inflation, which has been higher and more persistent than initially expected. Policymakers are waiting for clearer signs that inflation will meet their 2% target before committing to any reductions. However, the Fed's leaning towards rate cuts doesn't signal a victory over inflation, but rather a response to the heavy debt burden in the U.S. economy. With the federal government carrying a staggering $35 trillion national debt and many corporations facing significant debt repayments, current interest rates are viewed as unsustainable. Peter Schiff believes that the Fed must lower rates to prevent a financial crisis. However, before doing so, they must convince the market that inflation is sufficiently under control to justify such cuts. This involves maintaining the perception of restrictive rates, even though rates have never truly been restrictive. Schiff criticizes the Fed's past actions, arguing they have not effectively addressed inflation concerns. He contends that if the Fed truly aimed to reduce inflation to 2%, they would raise rates instead of pausing. The prolonged period of near-zero rates has exacerbated current inflationary pressures, creating a perception that inflation is under control, even if it means maintaining a facade of restrictive policies is crucial for the Fed's next steps. Let's get back to the interview.
The Fed is really looking for is an excuse to do what it needs to do anyway, which is to cut interest rates. In fact, as I mentioned on the last podcast, the Canadian Central Bank, the European Central Bank, they've already cut interest rates, even though inflation remains well above their so-called 2% target. The same thing is true with the U.S. But I think what the Fed is trying to do is to maintain a pretense. The Fed wants to fool the markets. That's the game plan, in the thinking that they're very vigilant on inflation. So they don't want to fold quickly and cut rates. They want the markets to believe that the Fed is being extra cautious to make sure that by the time they cut rates, that they're confident that inflation is going back down to 2%, because they know they're going to cut rates, not because they've won the battle against inflation, but because they've lost. They have to concede, surrender, but they can't admit that. They need to cut rates because rates are too high for a overly leveraged economy to bear. Not just the government, which has a $35 trillion national debt, but corporate America. Is a lot of debt that U.S. corporations took out years ago that is going to be maturing and that needs to be refinanced in 2025 and 2026. And companies can't afford to refinance that debt. Banks are in a lot of trouble because of the mortgage debt that they own and the treasuries that they own. So the Federal Reserve knows that in order to keep this financial house of cards from imploding, it has to cut rates. But it can't cut rates unless it convinces the market that it's already, beaten inflation. It has to create the perception that the rate cuts are justified. And so it has to pretend that it's holding rates at a restrictive level long enough to be certain that inflation is coming down. But all of this is a ruse because rates are not restrictive. They've never even moved into restrictive territory. I've argued this the entire time. Everything that Powell said during the press conference and in their official statement is wrong with respect to the Fed's commitment to bring inflation back down to 2%. If the Fed really was committed to doing that, it would be increasing interest rates. It wouldn't have stopped hiking them. In fact, if the Fed really cared about inflation, it wouldn't have lowered rates to zero and kept them there as long as they did. Powell mentioned that inflation is creating an economic hardship, which is true. Well, if that is the case, why did the Fed wait so long to raise interest rates? Why did the Fed deliberately allow that hardship to get worse before it took any action? In fact, when the Fed saw that inflation moved above 2%, it didn't immediately raise rates. In fact, it didn't raise rates before inflation got to 2%. The way it's saying it wants to cut rates before it gets down to 2%. See, when inflation was below 2%, the Fed was willing to give inflation a lot of slack. The Fed was reluctant to be preemptive about preventing inflation from rising above 2%. But now it's saying we don't have to wait for inflation.
Gold prices are currently navigating through a mix of influences. Positive U.S. jobs data and reduced Chinese buying are putting downward pressure on prices, while geopolitical tensions and potential purchases by central banks are providing support. If China decides to resume its gold buying spree, this could potentially give a boost to gold prices, driving them towards higher resistance levels. Share your thoughts on Peter's prediction in the comments section below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more insightful updates like this. Thank you for watching.